And so Friday will be the big day to look out for. We've just seen Nvidia earnings down 8% after earnings that by and large appear to have looked pretty healthy in my mind, a beat on earnings and revenues, and with very strong outlook. But nonetheless, markets not taking that too well as things stand. That might turn around yet. So let's look at inflation. First and foremost, we're talking about the core PCE inflation metric. It's the favored metric from the Federal Reserve. And that is a good thing because ultimately it's the core PCE metric, which is the closest to target. 2.63 for the core PCE figure, below the likes of the CPI and the core CPI readings. And so really this is the inflation gauge that gives us the ability to dream of potential sharp reductions in terms of interest rates. Now, bear in mind, we have been seeing significant weakness in terms of the jobs market. We've seen the rebound in unemployment really leading to question marks about the possibility of a recession in the US. And so with the potential weakness in terms of the economic side of things being tallied up against the declines in inflation, that provides the basis for further downside in terms of expectations for interest rates. But are we going to see inflation continue to move towards the downside? That's what's going to be key. You can see it has been a steady move towards the downside in terms of this core PC inflation metric to get us where we are at the moment. But the closer we get to 2%, the more we can start to think about what happens around that area where we get beyond 2%, we start getting under 2%, and we start thinking about the worries of sub-target inflation. Now, in terms of what markets are looking for this time around, well, it's not necessarily too encouraging. And you can see that in the bottom section here that we've got the core PCE monthly figure expected at 0.2%. And of course, if you look, there's 12 months. So if we had 0.2%, that essentially puts us on track for a roughly 2.4% inflation rate. So that would be marginally below where we are at the moment. But nonetheless, markets are expecting the year-on-year figure to remain at 2.6%. Okay, so we're not necessarily going too far, and by and large, markets can just say, well, maybe we're near enough. The Federal Reserve seem quite happy with where we are at the moment. And given the question marks we're seeing in terms of the jobs market, that does mean you have still a very strong possibility that we will see interest rate cuts coming from the Federal Reserve. Now, in terms of the outlook from the Cleveland Fed, that tallies up with it. I mean, you might remember last month I was showing you the disparity between what markets were expecting and what the Cleveland Fed was expecting, and ultimately it went the way of the Fed, and we saw a surprise in terms of the markets as we saw the figures matching what the Cleveland Fed had been pointing towards. Well, here they're looking for a core PC year-on-year figure of 2.47, so essentially 2.5, and a monthly figure of 0.2. So the 0.2 is what is expected. In terms of the 2.5, that is marginally below. So that, currently we're at 2.6. So the Cleveland Fed are pointing towards this core PC price index coming in below that. Now, if we see this disinflation trend continuing, it's going to likely embolden people in terms of thinking, well, the Fed are going to feel like we're really on a pathway back down to target and that they can act in a more meaningful manner. Of course, there's a fear that if they start cutting rates very swiftly from here onwards, they could stoke a second round of inflation. If we see inflation continue to move lower, that fear might not necessarily be as prominent. Here's a breakdown in terms of a number of different ways of looking at inflation over in the US. Now, you might look at the core CPI figure, which, as you can see here, 3.17. You might want to look at shelter because of the massive role it plays. It's a third of the CPI comes down to shelter costs, and you can see here 505 in terms of that figure. So very elevated, but very much on a downward trajectory. So this is going to likely provide a downward tailwind for CPI going forward. As we were talking about last month, there's a difference between the CPI method of calculating shelter and how housing costs are calculated within a core PCE figure. That could provide a continued tailwind for the CPI side of things, and that could provide a tightening between these two figures. So maybe a slowdown in the disinflation figure for the core PCE and continued downside in terms of the core CPI due to that relatively lagging shelter metric that continues to move towards the downside but remains elevated for that figure. So as we can see here, if you strip out the shelter figure from the core CPI, you're at 1.77. So if you're like many people within the markets, the kind of person that looks at shelter and says, hey, the way that they're calculating it and the lagging way that it's factoring into prices means that we shouldn't necessarily pay as much attention to this methodology as the Fed are doing so. Well, you can see here that without it, inflation on the core side of things would be below target. Now, in terms of that breakdown, we can see this here. This is a chart that I had from last month. Again, that impact that we're likely to see in terms of shelter, how it's going to more greatly affect that CPI figure rather than the core PCE figure. So I think there's a good chance that while core CPI is likely to continue to trend lower and CPI, we could see the PCE figure relatively flatlining. Now we can see here in terms of the breakdown of the two different core metrics, the CPI and the PCE. CPI at 3.2, PCE at 2.63. The figure that's dropping out last time around is 0.12 from July of 2023. The figure from last month for the PCE figure was 0.182. And so we can see that by and large, the figure that's dropping out is lower than pretty much every figure that we can see over the past like 6-7 months, right? So it's going to be quite difficult to see that disinflation on the headline on the yearly figure that's expected from the Cleveland Fed. And so if we're looking beyond that, you can see from last year, July is a low figure. August is even lower. September is relatively high. So we'll see some disinflation coming into play in September, more likely. You know, that could simply be a 0.1% drop. And then October, November, December, all of them relatively low. So there's a good chance that we're going to remain in the mid twos for the rest of this year. And so, you know, what's going to be driving this potential sharp decline in terms of interest rates in the US? Well, it could come down to the jobs market. The jobs market has been showing signs of weakness, but certainly it's worth bearing in mind that we're likely to see the core PC inflation metric remain pretty much steady for much of the rest of the year, with the one exception coming in with the September reading. And when September's stripped out, that's when we're likely to move from, let's say we're at 2.6% or 2.5%, maybe we could get down to 2.3%. And then we hang around there and we move a little bit higher. It is the kind of area that the Federal Reserve, I don't think, are necessarily going to get too pernickety and start saying, no, we need to get that 0.3 knocked off. But certainly in terms of the market perception, you need to see this dual mandate playing out. The weakness in terms of the job markets tallying up with declines in terms of inflation. That bodes well for expectations of additional rate cuts, because right now markets are feeling very positive about the idea that we're going to see easing from the Fed, so much so that they think we're going to see 100 basis points of downside this year. That's 3 meetings, and 200 basis points worth of downside over the next year. So essentially next year we're expecting to see more of the same, more downside in terms of rates. And this year they're expecting to see a 50 basis point cut somewhere in the next 3 meetings. Will that be justified? Have they gone too far? Are we likely to see that road back? Will we see an additional expectation added on top of that? All of these things are key. And so what I wanted to show you here is that we've got this relationship between the view of where rates are going to be by the December meeting. And so I've got that in terms of rate expectations. And that's in the green line. And then, you know, where's the US dollar? Where's the US 10-year yield? So we do have this close correlation between the two. For some reason, I added to this slide, I actually removed the 10-year because the 10-year is great. And I often show you the relationship between the US dollar and the US 10-year. But I also had on the top section of this chart, I replaced that US 10-year yield with the relationship between the Dow Jones Industrial Average and the DAX, and it essentially mimicked this relationship. So it pointed towards outperformance for the Dow at times when we see additional expectations of easing from the Federal Reserve, and outperformance from the DAX when markets start to row back on that. And that, stands to reason that markets feel more optimistic and bullish at times when we see additional expectations for easing from the Federal Reserve. So what are we expecting here? Now, the key thing here is, like I said, markets are pricing in 4 rate cuts, or essentially 100 basis points worth of cuts this year. Are we going to see them push for 125? I think it's unlikely. For that to happen, we'd need to see really significant signals of weakness in the jobs market and then disinflation. And so the disinflation picture comes into play here. Do we see the core CPI, core PCE metric drop down to 2.5, 2.54? If that happens, you're likely to see weakness in terms of the US dollar. You're likely to see relative strength for the Dow compared to markets such as the DAX. If we see inflation remaining flat or moving towards the upside in particular, then you could see the opposite. You could potentially see some upside in terms of the US dollar index and the US dollar as a whole, and then some outperformance for, say, the likes of the DAX, and underperformance for the likes of the Dow. I think it's quite likely that we do soon enough see people tempering their expectations a little bit, but it really comes down to some of these figures and exactly how they come out. Now, in terms of the Dow Jones Industrial Average, this is the market at the close. We have, of course, seen those NVIDIA earnings since, but NVIDIA is not part of the Dow. That's why I wanted to utilize it for this analysis. And essentially highlight the fact that we have got a market that has managed to hit record highs, tentatively so. It's pulled back, but have we broken out of this near-term trend? No, we haven't. So you've got a key level down here that if we break the 40584, it starts to point towards another sort of wider pullback coming into play for this market. There's likely to be ramifications for other stocks. It's not necessarily the case that NVIDIA drops 8% and the rest of the market is completely fine with that. We're likely to see maybe some jitters. But in my mind, I don't necessarily think there's a justification for a massive sell-off off the back of those numbers. We've seen it time and time again for many of these tech names. We've seen them come out with earnings in this same quarter, this second quarter earnings season, many of which have been absolutely bumper, strong growth numbers. And then markets have found something to nitpick over and somehow have sold off. Now, that generally doesn't last forever, and we ultimately see them back at record highs more often than not. So I'm not necessarily thinking that all is lost on that front, and therefore near-term jitters, I don't know if they're going to last per se. But if we break the 40584, it looks like we're going to see a potential wider pullback for this market. And certainly when we come into Friday, things are likely to have settled somewhat. And so the weakness for the Dow would likely come if we were to see an upside move in terms of that core PCE inflation metric. And the rebound, the continuation would be more likely in the example of the Cleveland Fed, where they've said that they think that it drops down to 2.5. So that disinflation trend should embolden the bulls once again. Now, this is the US dollar index. We've seen a little bit of a rebound recently, a bit of consolidation here, pulled back or moved towards the upside, set within a very clear downtrend here. This is the daily time frame. You can see that July and August have been pretty unforgiving for this market. But crucially, we've come into a really interesting zone of support. Let's see where these lows are. So we've got the 100.8 and down here, 99.57. And then we've got a few more down here, which are sort of tallied up with that original area here. I think there you go. That first one wasn't correct. Let's get rid of that. So this area of support is currently where we are at the moment. You're seeing weakness in terms of NVIDIA. That points towards a possibility that we see some strength in terms of the US dollar. We've seen a bit of a pop, but really we need to see a rally up through this near-term swing high. It's more evident on a 4-hour chart. So a break up through this 101.64 really starts to point towards a more protracted move towards the upside to build on the gains that we have seen here. But nonetheless, when we're looking at this core PCE survey, if we were to see some weakness in terms of that inflation metric, then we're likely to see additional expectations piled on where rates are going to be by year end, by middle of next year, those kind of things. And that would likely drive further downside for the dollar index. So if we're looking for further downside in terms of inflation, if we see that, we're likely to see this continuation play out with another rolling over and a breakdown through that 100, that key 100 mark for the dollar index. If we were to see some strength coming into play here, I think there's a good chance that we could see a little bit of an unwinding of that recent move in terms of 100 basis points worth of cuts this year and things like that. Maybe we would start moving towards a 75 basis points move, and that would likely bolster the US dollar for the time being anyway. So certainly the key line in the sand here is 101.634. Certainly if we break up through that level, you're looking for a more protracted move. But until that happens, there's a possibility that we see this market roll over once again.